Welcome to the ProTicker Deep Dive. When we look at the market, we're sort of conditioned to focus on one number, right? The index price.
Mm-hmm.
The S&P 500, the NASDAQ, hitting new highs. It's like admiring the height of a skyscraper.
Yeah, but a bull market rally, just like that massive building, is only as strong as its foundation.
And lately, that foundation has felt a little shaky. So the central question for our deep dive today is, well, it's pretty existential.
It is.
How do we, as informed investors, know if the current rally is truly healthy, durable, and built to last?
That's absolutely the right question. We have to look past the headline numbers to assess the market's internal mechanics, especially after the huge gains we've seen.
So where do we start?
We really rely on two primary metrics that give us that internal view. The first is market breadth.
Market breadth.
You just ask, how many stocks are participating? Is it a whole market advance, or are we, just riding on the backs of a few massive winners?
And the second metric.
That would be leadership quality. It forces us to look really closely at the stocks that are driving the index higher.
So are they built on hype and speculation? Or are they fundamentally sound, profitable giants?
Precisely. Because if the rally is narrow, you need those leaders to be rock solid to avoid a systemic failure.
So our mission today is a deep analysis. We're going to dig into narrow versus broad rallies using historical examples, quantify how concentrated the market has become, and then figure out what the trends we saw in late 2025 and into early 2026 really mean for the future.
Exactly. We're going beyond the headline to give you a genuine understanding of what's happening beneath the surface.
Okay, let's unpack this. So let's start with some simple definitions. We're contrasting a broad rally.
Where you see wide participation across pretty much all sectors.
Right, that validates the move. And we're contrasting that with a narrow rally.
Which is driven by a small cluster of, superstar stocks carrying all the weight. High concentration.
And history tells us that concentration is where risk likes to hide.
It's often the most dangerous place. To understand this, we have to start with the classic example. The Nifty 50 in the early 1970s.
Ah, the one decision stocks.
That's them. About 50 blue-chip growth stocks, think IBM, Coca-Cola, Disney, that were considered completely infallible. You just bought them and forgot about them.
They felt so safe. But the data on them, it paints a pretty frightening picture of overvaluation.
Frightening is the right word. Their average price to earnings, or PE ratio, hit an astronomical 42 times earnings.
Wow. And for anyone who doesn't know, a PE ratio is just how much you're paying for $1 of that company's profit.
Exactly. So people were willing to pay $42 for $1 of current earnings. That was more than double the broader market's PE at the time.
That's pure euphoria. So what did that do to market concentration?
It was massive. The top 5 stocks alone made up around 23% of the S&P 500's market cap.
A quarter of the index on just 5 companies.
Yeah. And the consequence. When stagflation hit in 73 and 74, the overvalued Nifty 50 just collapsed violently. They fell 19% one year, then another 38% the next.
So the lesson there is that even great companies can destroy your capital if you pay a crazy price for them. That's a tough lesson in valuation risk.
Absolutely. High quality does not mean you're immune to gravity. Now let's fast forward to the late 1990s, the dot-com bubble. Another narrow rally, but a completely different reason for the failure.
Right. If the Nifty 50 were high quality but overpriced, the dot-com leaders were often just low quality and overpriced.
Precisely. The narrowness was all about speculative frenzy, all narrative and no revenue. The data is just staggering.
How so?
The top 15 performing stocks contributed nearly 70% of the S&P 500's total gain in 1999.
70%.
So if you weren't in those specific stocks, you felt like you were standing still. And the key difference from the 70s was that leadership quality. So many of them had flimsy fundamentals.
No profits, sometimes not even a real product, just an idea and a website.
Exactly. And the outcome reflected that weak foundation. Because the rally was built on speculation, the collapse was just total. The NASDAQ plunged almost 80%. S&P 500 fell 50% between 2000 and 2002.
So then this is where it gets really interesting. Narrowness isn't always a death sentence. The 2015 FNG-led rally showed us that.
This is the essential positive twist. The 2015 rally was shockingly thin. I mean, just 5 stocks, the original FNG group, they accounted for the S&P 500's entire net gain that year.
The entire gain from 5 stocks.
The entire gain. Goldman Sachs had a breadth measure that plunged to near all-time lows. It felt exactly like a house of cards.
So why didn't it crash like in 73 or 2000?
Because the narrowness resolved positively. We saw a modest healthy correction in early 2016, but instead of the index collapsing, the money just rotated.
Hmm. So breadth began to broaden out.
Yes, cyclicals, value stocks, the laggards,
Yeah.
they all started to catch up. The narrow leadership acted like a magnet, and it eventually pulled the rest of the market up with it.
So narrowness is a double-edged sword.
It really is.
Yeah.
Historical studies show it can signal a top, but about half the time, it actually precedes a broader, extended rally.
Okay, so that's a powerful insight. Let's move from anecdotes to actually quantifying this. How can we put a number on concentration risk in real time?
We can turn to the indices themselves, specifically by comparing two versions of the S&P 500.
Right.
The one you always hear about on the news is the cap-weighted S&P 500.
Where the biggest companies have the biggest influence.
Exactly. If Apple has a 7% weight, its move matters way more than a smaller company.
Okay, so what's the alternative?
The alternative is the equal-weighted S&P 500. In this one, every single stock has the same weight, about 0.2%. It's a pure measure of how the average stock is doing.
And the signal is the gap between them.
The divergence, exactly. When the cap-weighted index dramatically outperforms the equal-weighted, it's definitive proof of narrow leadership. It means the biggest stocks are doing all the heavy lifting.
And we saw this divergence get pretty extreme recently, didn't we?
We did. In 2023, the gap was about 12 percentage points for the year.
12 points. That is staggering.
It is. It means if your portfolio held all 500 stocks equally, you missed out on 12% of the returns the headlines were screaming about. That divergence is the concentration risk.
And what does history say happens after a gap like that?
Historically, it's almost always followed by periods where the equal weight index outperforms. It's just mean reversion. The laggards catch up.
Okay, beyond index divergence, there are some key technical indicators analysts use. Let's walk through these because they're so important for monitoring risk.
Sure. Let's start with the advanced decline line, or AD line.
Okay, what's that?
Think of it like a cumulative vote count for the market. Each day, you tally the stocks that went up versus the ones that went down. The AD line is just a running total of that difference.
So in a healthy market, the AD line should be rising with the index.
It should be confirming the new high. The big warning sign is divergence.
The index hits a new high, but the AD line is flat or falling.
Exactly. That means a few mega caps are dragging the index up, while most stocks are actually struggling. We saw that exact divergence in late 2021, right before that big sell-off.
Okay, indicator number 2 tells us how many stocks are actually in an uptrend.
That's the percentage of stocks above moving averages. We often look at the 50-day or 200-day average. Think of the 200-day like the long-term current of a river.
Right.
If the index is hitting a new high, but only, say, 40% of stocks are above that current, it screams that the rally is fatigued.
A really healthy bull market would see, what, 80 or 90%?
At least. Low participation means the average stock is struggling.
And the last one, new highs versus new lows.
This one measures momentum. In a healthy market, you see lots of stocks hitting new 52-week highs, very few hitting new lows. The most ominous sign is when the index is climbing.
But the number of new highs is drying up and new lows are actually increasing.
You got it. We saw that exact ominous pattern in mid-2007. It basically presaged the 2008 downturn because the base of strength had already crumbled.
So the takeaway is that these aren't timing tools, but they are essential risk management tools.
Absolutely. Divergence warrants caution. Alignment confirms durability.
Okay, so we've covered how many stocks are rising. Let's shift now to who is leading. Leadership quality is the next critical piece of this puzzle.
And this is where the narrative around today's market, specifically the Magnificent Seven, gets really complicated.
How so?
If we compare the Mag 7 to the Nifty 50, there's a key similarity. Both groups are fundamentally high-quality businesses.
Huge revenues, strong balance sheets, dominant market positions.
Right. They are not the shaky, unprofitable companies of the late 1990s.
That makes the current situation less scary than the dot-com era. But critics still say the Mag 7 valuations, their PE ratios, are way too high, just like the Nifty 50.
And that's the challenge. The Mag 7's valuations were high, and average PE around 37x in 2023. No doubt that's expensive.
But there's a but.
There's a huge but. And this is the critical distinction. Their high valuation was backed by phenomenal earnings per share, or EPS growth. We're talking an average of about 34% annual EPS growth recently.
34%. So you're saying they're expensive, but they're earning that valuation at a rate the Nifty 50 or the dot-com leaders just weren't.
Exactly. The Nifty 50 had quality products, but their growth rates couldn't justify that 42x PE. The
Wow.
dot-com leaders had no earnings at all.
So the foundation, while narrow, is built on concrete, not sand.
A much better way to put it. It makes the current rally far more resilient.
Okay, let's pull the lens back, because so far we've only focused on U.S. concentration. We need to check the global pulse.
A global check is critical. While the Mag 7 represented nearly 30% of the S&P 500, markets in developed international regions, especially Europe and Japan, were having much broader rallies.
How broad.
Very broad. The equal-weighted versions of their indices had some of their strongest starts in decades. They were being driven by diversified sectors, value, industrials, financials.
The exact sectors lagging in the U.S.
Precisely. It shows a clear benefit of diversification for the listener.
But then you have emerging markets, which are often a totally separate universe of risk.
EM is often top-heavy, but recent concentration there has been intense. Returns have been dominated by a few mega caps like TSMC, Samsung, and Tencent.
And the data shows that.
Yeah, data show that only about 1/3 of EM stocks managed to outperform the overall EM index recently.
Right.
So 2/3 of the stocks were lagging.
So globally, a mixed picture. Broad strength in Europe and Japan, which is healthy, but high concentration in both the U.S. and emerging markets.
That's the global synthesis. It's a mixed signal, which requires a targeted approach.
So let's bring this all home. It's early 2026. What does the synthesis of all these signals mean for the durability of this bull market going forward?
The key theme since the extremes of 2023 has really been a tentative broadening. We've moved past that moment of peak fear. We saw U.S. small caps and equal weight indices have meaningful periods of outperformance in mid to late 2025. And crucially, those technical breadth indicators have improved a lot.
Like the percentage of stocks above their 200-day moving average.
Exactly. That river current metric,
Yeah.
it's climbed back to the 60 to 70% range. That's so much healthier than the distress levels we saw before.
So the foundation is getting stronger, but leadership is still pretty much anchored by big tech.
It is, but their fundamental quality remains high, which is that necessary safety net. Plus, we've seen healthy rotation within the Mag 7,
Right. Some go down 10-20%, others pick up the slack.
which suggests healthy stock-by-stock churn, not a collective collapse. That rotational strength can actually prolong a bull run.
So if we weigh the risks against history, this feels more like the 2015 or 2020 pattern narrowness that broadens out rather than the 73 or 2000 crashes.
That's the most likely scenario, I think. The confidence really comes from that combination of high-quality leaders and a potentially supportive macro backdrop, an expected Fed easing, a soft landing.
So that combination increases the odds that the rest of the market will expand rather than everything just collapsing together.
Exactly.
Okay, so for you listening, what are the 3 key signals you need to be watching to confirm this positive path?
First, you want to see continued breadth improvement. You want to see the equal weight indices consistently outperforming cap weight.
And the AD lines confirming new highs.
Yes, that alignment would dramatically augment the market's durability.
Second,
Watch for a breadth rollover. If those technical indicators start to deteriorate again, especially if it lines up with some unexpected macro stress, well, that raises the House of Cards flag, just like in 2007,
and the crucial third signal.
the emergence of new leadership. Durable bull markets need many engines. We need strong leaders to emerge from lagging sectors, industrials, healthcare, materials.
To avoid a vacuum if tech stalls.
It's absolutely crucial.
Yeah.
The good news is that earnings growth is widely expected to broaden out beyond big tech through 2025 and 2026.
So the market presents a picture of guarded optimism. The foundation is stronger than past bubbles, but the concentration risk is still high enough that we need to be diligent.
And that's the final provocative thought for you to carry forward. Remember that durable bull markets require many engines. Don't just focus on the price trend of the index. Focus on whether the majority of stocks are confirming that strength beneath the surface.
Because that's where true market health is revealed.
That's it.
Excellent insights. Thank you for sharing your source material for this deep dive. See you all in the next Pro Ticker Deep Dive.